It is officially finished now. For years, the squeeze was just a theory. We watched charts track the leverage and warned that banks would get trapped by their own paper scams. The shorts were bound to fail. That was just a strong probability. Today it is undeniable proof. Quit the paper speculating. The dead body has been found here. While retail investors watched the spot price surging on screens, something way more critical was occurring out of sight. Not on the news, not in the papers, but deep inside the rigging's most sensitive pressure point. In the quiet hours past Christmas, when volume was thin and eyes were off, a specific figure appeared on a Federal Reserve report. That figure was definitely not routine. It was a massive confession. More than $17 billion was yanked from the Federal Reserve emergency liquidity window in just one morning. This is not where sound banks go. This is the fiat financial emergency room. You only show up here when something is breaking. Ask yourself why the bullion banks that claim to rig global markets would need billions in overnight fiat at dawn the day after a holiday. It wasn't for growth. It wasn't for operations. It was because a trade moved violently against them, and a margin call arrived that their rigged balance sheets could not absorb. This is where the theory ends and hard math takes over. When spot moves fast enough, the accounting tricks stop working. Unrealized losses become immediate demands for fiat. The system does not care for narratives. It only cares about collateral. That $17 billion was hardly support. It was a tourniquet, a last attempt to stop a bleed before forced liquidations ripped through the exchange. And the timing matters here. Crises are buried on Fridays because silence hides fear. This wasn't about silver's spot price. It was purely about solvency. And this is just only the beginning. If this intro already has you thinking differently about what just happened, make sure you subscribe to the channel now so you do not miss what comes next. And comment one below if you are ready for Chapter 2, where we link this margin call directly to the silver explosion and explain why everything just changed. Now connect the timing because markets do not move like this by pure accident. The same morning banks rushed to the Federal Reserve for emergency fiat silver did not drift higher. It exploded. It moved fast enough to break assumptions the system relies on. This was surely not coincidence. It was clearly cause and effect. The institutions at the center of this were trapped in massive naked short positions built for years. Those trades only worked as long as volatility stayed low and liquidity stayed abundant. Both vanished at once. In futures markets, losses are immediate. Every dollar move against a leveraged position increases risk in real time. And when spot price moves far enough, the clearing system won't negotiate. It demands fiat. That heavy demand arrived. Silver crossed internal risk thresholds that banks rely on to stay solvent. Models failed. Value-at-risk assumptions broke. What had been labeled temporary instantly became existential. This is where unrealized losses turn into big survival problems. When the margin call hit, the banks checked their vault and found a gap. Liquidity was gone. Selling assets would worsen the situation, and buying back shorts in a rising market would accelerate the damages. So they ran to the only safe place left. They pledged what collateral they had and tapped the Federal Reserve emergency facility, not to profit, not to stabilize markets, but to avoid immediate liquidation. That fiat was not about winning. It was about staying alive just one more day. This is why the repo spike matters. It was not precautionary. It was reactive. It was the financial equivalent of grabbing for oxygen as the fire spread. And here is the turning point. When institutions stop controlling price and start responding to it, the balance of power shifts. The tampers lose all control. The market takes it back. That shift marks the transition from managed markets to raw survival markets. And once that red line is crossed, there is no easy way back. This is where most people misunderstand what just happened. They hear the word repo and assume this was routine plumbing, a temporary cash shuffle, a technical adjustment that would quietly resolve itself. That interpretation misses the signals entirely. Liquidity problems happen in our healthy systems. Solvency fears appear when the trust breaks. If these banks were truly sound, they would have borrowed from each other. That is how the system is designed to work. Interbank lending exists so strong institutions never need to touch the Federal Reserve emergency window. Going straight to the Fed is not neutral. It is a public admission that peers no longer trust your balance sheets. That distinction is very critical. When banks bypass the market and run directly to the central bank, it tells you two things at once. They need cash immediately and no one else is willing to lend it. That combination defines stress, not convenience. And it is how real confidence evaporates. Silver's surge did not just create losses. It exposed leverage that could no longer be financed. Positions that looked manageable on paper collapsed when marked to market. Collateral values fell while obligations remained fixed and the gap had to be filled with fiat. That cash was surely not there. So the Fed stepped in not as a facilitator but as lender of last resort. That is not stabilization, that is life support. And institutions on life support do not dictate markets. They react to them defensively and under vast pressure. This is why the tone of the silver market is changing. The players that once capped rallies are now constrained. Their balance sheets are damaged, their risk tolerance is gone, suppression requires confidence, and confidence has cracked now. This was not a mere funding hiccup. It was a huge structural warning. And once markets sense weakness at the core, they do not slow down yet. They accelerate fast. Here is the shift most people still have not fully grasped. This crisis did not stay confined to spreadsheets and terminals. It did not remain a paper problem. It crossed a line. And once that line is crossed, markets behave so very differently. Paper markets will fail quietly. Physical markets fail very loudly. For years, banks could manage price through leverage. They sold contracts instead of metal, promises instead of ounces, as long as most participants treated silver as a trade, not as a necessity that system held. Losses could be rolled, positions could be extended, delivery could be deferred now. That market dynamic just changed. When prices move far enough and confidence breaks, the question shifts from what is price to can you deliver? And that question is lethal to a paper Ponzi system, because delivery is binary. You either have the metal or you don't. As silver surged, something unusual happened. Contracts weren't rolled forward. They weren't closed for cash. They were held to expiration. That behavior tells you everything. It signals that buyers no longer trust settlement promises. They want the metal, not the payout. This is where banks face a different kind of risk. Cash can be borrowed, liquidity can be printed, but real metal cannot be created on demand. When delivery pressure rises, every short position becomes a ticking clock. And those clocks don't negotiate. This is why the repo bailout didn't solve the real problem. It only addressed the cash side of the equation. It did nothing to increase supply. In fact, it made the situation worse by reinforcing the fear that paper claims are totally unsafe. Once a market shifts from trading price to demanding delivery, the balance of power flips. Sellers lose flexibility, buyers gain leverage. Volatility increases not because of speculation, but because of actual scarcity. This is how suppression ends, not with a headline, not with a declaration, but with silence from the sellers and pure urgency from the buyers. At that point, price is no longer a debate. It becomes a rationing mechanism. And when a strategic asset reaches that phase, history shows only one outcome: a massive repricing. This is the paradox at the heart of what we are witnessing. The intervention that was meant to stabilize the system is actively accelerating the forces breaking it. The $17 billion injection didn't restore confidence, it exposed fragility. Because just look at the mechanics. The banks needed cash because silver was rising against the dollar. That price move signaled stress. The Federal Reserve's response was to create more dollars. But printing dollars to defend against a rising hard asset does not fix the imbalance. It amplifies it. Every new fiat dollar injected into the system dilutes the existing ones. That dilution pushes investors further towards scarce assets, which pushes prices higher, which deepens the losses on the very short positions the bailout was meant to protect. This is a feedback loop. The higher silver goes, the more support the banks need. The more support they receive, the weaker the currency becomes. And the weaker the currency becomes, the higher silver goes. There is no exit that preserves both the banks and the purchasing power of money. This is why markets reacted the way they did. The bailout wasn't interpreted as strength. It was interpreted as surrender. It told investors that the central bank will choose currency debasement over institutional failure every single time. That knowledge changes behavior instantly. Once participants understand that losses will be socialized and money will be printed to cover them, holding cash becomes a risk. And when cash becomes a risk, capital seeks shelter elsewhere. This is how inflationary regimes begin, not with announcements but with forced decisions. The Fed didn't choose this path willingly. It was pushed onto it by leverage scarcity and bad timing. And now the market knows the rules. If prices fall, the shortage remains. If prices rise, the Fed prints cash. Either way, the pressure builds. This is why the bailout wasn't the end of the story. It was the trigger that locked the system into a one-way dynamic. From this point forward, every attempt to stabilize creates more instability. Because you cannot solve a scarcity problem with a printing press. This is where the psychology of the market finally snaps. For decades, there was a reliable pattern. Whenever silver rose too fast, so short sellers stepped in. They faded the move. They provided liquidity on the sell side, price spikes were punished, and rallies died young. That reflex just broke down. When silver surged this time, the shorts didn't attack. They retreated, not because they wanted to, but because they had to. The math no longer worked. The risk no longer made sense. Shorting silver stopped being a trade and started looking like a suicide mission. This is what capitulation looks like. When shorts leave this market, something dangerous happens. Liquidity disappears. The sellers who used to cap rallies are gone, and price is left to float higher on even modest buying pressure. Moves become sharper. Gaps appear. Volatility explodes upward instead of oscillating. This isn't a traditional short squeeze anymore. In a classic squeeze, shorts are forced to buy back positions, creating a violent spike followed by relief. What we are seeing now is different. It's a vacuum. The shorts have already covered or stepped aside, and no one is willing to replace them. That creates a one-sided market. When price rises and no one steps in to sell, every buyer has to pay up. Every transaction happens at higher levels. This is how markets reprice, not gradually, but in big jumps. The absence of shorts is not a bearish signal. It is a declaration of fear. It tells you that professional risk managers have looked at the data and decided there is no safe way to bet against this move. And once that realization spreads, it feeds on itself. New money enters. Old skeptics capitulate. Momentum replaces disbelief. What used to be suppressed becomes chased. This is the phase where narratives change. Silver stops being dismissed as a relic and starts being treated as protection. Not because of hype, but because the mechanisms that kept it contained no longer function. When control shifts from sellers to buyers, markets do not ask for permission. They move until a new equilibrium is forced. And that equilibrium is always higher than anyone expects. This is the point where stress becomes visible. Not through price alone, but through behavior. In a normal futures market, most contracts never reach delivery. Traders roll them forward or settle in cash. That is how a paper system survives. But this market stopped behaving normally. As silver surged, contracts weren't being rolled. They were being held. Buyers stayed in the trade all the way to expiration, demanding the warrant. That shift is critical. It means trust in cash settlement is fading. Participants no longer want exposure. They want possession. Delivery demand changes everything. As delivery claims spike, the naked shorts run out of time. Every contract is a ticking bomb. Cash settlement is a choice. Physical silver isn't. Unlike fiat, you can't print more shiny to fix a panic. Here is where paper leverage meets hard reality. Vault inventories appearing safe on reports suddenly look thin when the claims stack up. Registered silver gets spoken for. Supply tightens hard. And once the market smells a delivery failure, the fear spreads faster than the spot price action. Because a default is purely binary. If delivery holds, the price must soar to ration true demand. If delivery fails, confidence in the paper market collapses hard. Either outcome favors the holder of the real physical metal. This is why delivery data matters more than headlines. It shows intent. It reveals who is trading and who is securing hard supply. And right now the signal is clear. Participants are choosing metal over money. That choice marks a transition from financial stress to structural stress, from volatility to fragility. When enough players make that decision, the rigged system cannot absorb it quietly. At that final stage, markets don't unwind. They fully reset. At this stage, the idea that this remains a silver problem is a big illusion. Markets built on leverage are never isolated. Stress travels. It moves through balance sheets, through collateral chains, through confidence itself. This is how real contagion begins. Silver was the trigger, not the destination. When a systemically important player struggles to meet obligations in one market, counterparties everywhere take notice. Margin requirements rise. Credit terms tighten. Liquidity that once flowed freely starts to really hesitate. And that hesitation is enough. The modern financial system is a web of interconnected exposure. Positions are hedged with positions collateralized with collateral, all layered on assumptions of stability. When just one assumption fails, pressure migrates instantly. This is why central banks react so quickly. They understand that a default in one corner does not stay there. A failed delivery or forced liquidation in metals doesn't end with metals. It cascades into rates, currencies, and global credit. The Fed's intervention wasn't about silver. It was about preventing that total cascade, about stopping one crack from spreading into a fracture. But here is the problem. Contagion cannot be printed away. Liquidity can delay it. It cannot erase it. Every bailout shifts risk elsewhere, often into the fiat currency itself. That ugly trade-off is now visible. As confidence in settlement weakens, participants demand higher margins. As margins rise, leverage falls. As leverage falls, asset prices reprice. This tightening happens not because policy demands it, but because broken trust does. This is the silent phase of crisis. No headlines, no panic, just subtle withdrawal, less lending, less risk, much less tolerance. And once that process starts, it surely feeds on itself. Because systems built on confidence cannot function when confidence becomes very conditional. Silver didn't just break the system. It fully revealed it. This is where the illusion of control finally collapses. The Federal Reserve stepped in to stop a fire, but in doing so, it locked itself into a trap with no clean exit. Every path forward now carries heavy consequences they can't avoid. Here is the real dilemma. If the Fed stops intervening, stress returns immediately. Margin calls reappear, liquidity freezes. Institutions already weakened face liquidation. That path risks a cascading failure the system cannot absorb at all. But if the Fed continues intervening, the currency pays the full price. Printing money to stabilize leveraged institutions does not restore confidence. It transfers risk from balance sheets into the dollar itself. And once markets understand that trade-off, behavior changes permanently forever. This is the pivot that no one announced. The Fed can no longer fight inflation and protect the system at the same time. It has chosen protection. That choice signals to global capital that real value will be defended with debasement, not discipline, sadly. And smart capital listens. When investors realize downside risk is capped by money creation, they stop hedging for deflation and start positioning for repricing. Cash becomes optional. Hard assets become strategic. This is not speculation. It is pure adaptation. That is why silver's move matters beyond its own market. It is exposing the limits of policy. It is forcing the central bank into reactive mode, and reactive policy is always lagging behind the curve. The Fed still has some tools. What it no longer has is real control. Once markets sense that they don't wait, they front-run the response, they move before policy acts, and when that happens, prices stop reflecting forecasts and start reflecting pure fear. This is the final stage before repricing accelerates. The point where authority yields to math, where confidence yields to real scarcity. And from here, the system doesn't return to normal ever. It fully transitions. This is where everything converges. Strategy replaces speculation. Reaction gives way to positioning. What began as a market event has now become a lesson in how systems behave when leverage, scarcity, and policy truly collide. The first lesson is simple. Systems don't break where people are looking. They break where assumptions live. For decades, the assumption was that paper markets could always be managed, that liquidity could always be injected, and that confidence could always be restored. That assumption is gone forever. The second lesson is more uncomfortable. There are no painless solutions left. The Federal Reserve has shown its hand. When forced to choose, it will sacrifice currency stability to preserve institutional stability. That tells you exactly where real risk is being pushed. From this point on, volatility is not a bug, it is a feature. Sharp moves, gaps, and violent smashdowns followed by strong rallies. This is repricing. When the rigging fails, expecting calm anchors you to a fiat past that no longer exists in this new and volatile market cycle now. So what does this mean for the physical stack? It means knowing that holding fiat trash is never neutral. It means seeing that physical silver behaves differently than paper promises. It means preparing for a world where spot prices move to ration physical supply, not just to please the paper market speculators' whims. The goal isn't just to call every dip, it is to survive the reset and emerge holding the real metal. That requires patience, discipline, and the will to ignore the bankster noise designed to shake your strong hands out today. History is clear on this point. When fiat regimes fail, wealth doesn't vanish. It moves. It transfers from those holding paper illusions to those stacking real sound money assets now. We are watching that great transfer start. This is not about panic, it is about awareness, seeing the rig for what it is, not the COMEX lie.